Good morning, ladies and gents, and welcome to the August edition of the Blackfinch 10-minute market forecast. Please you can join us today. My name is Jordan Kent, Distribution and Sales Executive for Blackfinch Asset Management, and I'm joined today by Mr. Josh Clayton, Listed Product Specialist for Blackfinch. For those joining us for the first time, the purpose of these webinars is to provide you with our take on the most important factors occurring in markets today. If you have any questions during today's webinar, then please let us know via the Q&A box at the bottom of your screens, and we'll come back to you at the end of the webinar. I will also provide you with our contact details to reach us directly. Before we begin, it's important to note the details we cover this morning is intended for financial professionals only, and that should not be taken as financial advice. Looking at our agenda today, we have 3 points. First, we'll address the change in direction for US equities despite robust earnings. We've seen markets have been on a strong run, lifted by earnings that continue to surprise. But despite that strength, we're now seeing a sharp reversal in momentum. So look at why that shift has happened and how it reflects the broader economic forces that are at play, rather than company performance alone. Second, we'll look at the hard economic data that's starting to show in the US. Up to now, the market rally has been built on confidence and the sentiment. What's different this time is that hard data is beginning to bite back, with jobs numbers, survey data, and policy noise all feeding through to markets. So unpack how these real economic signals are driving volatility and why investors are suddenly starting to take notice. And finally, we'll look at the heart of all this, which is the US jobs market. Recent figures show the weakest job creation in years, with important sectors under real strain. So we'll review the trend shape in the labour market and look at why this matters so much for the economy and for the Fed. So putting these 3 things together, ultimately what we're looking into today is that the story isn't just about earnings anymore. It's about the economy showing in the numbers and the jobs market sitting right there at the centre. With that said, I'll hand over to Josh to run through these points in detail. Morning, Josh.
Good morning, everyone, and thank you, Jordan. That's a great summary again there. So let's dig into the meat of this, because what a month it's been, and certainly a lot to look out for going into the final third of the year. I've got some charts to show you over the next few slides, but before we move on to them, I think we need to set the scene first of all. A lot has happened in a short space of time, and in fact, these themes on the screen are all going to be nicely knitted together. So as we know, equity markets have been on a climb over July, and really since they rallied after the April Liberation Day impacts. And since then, it's been a risk-on market, and there have been a lot of reasons for that, whether it's the walk back on tariffs by Trump, economic stimulus in Europe and China, or the AI boom still going on across the world. And for investors, it's very easy for emotional behavioral biases to become some of the driving factors of our decisioning. And this has been really case in point recently, where we've seen indices reach all-time highs, swept up in the excitement by strong earnings in US tech, with Nvidia being the obvious example. And many have argued that investors have become too risk-on recently, neglecting important fundamentals that we're typically going to look at. And it's precisely that point that spurred a change of fortunes, and this is the US economy. So this chart on the screen just shows how quickly momentum can reverse, and what seemed like an unstoppable rally for risk assets switched. And in fact, I was sipping my coffee this morning, and it looks that investors are putting risk back on the table, and markets are rallying. So elevated volatility levels is the key thing currently. But before we explore why we're having this volatility, if you look at the US market from an earnings perspective, there's no denying it sits at the top of the pack against peers. We still have companies reporting, but on aggregate, earnings have beaten analyst estimates yet again, pretty much across the board. And when I say that, we're talking about the constituents in your S&P 500, so large or mega cap, well-recognized names across the world. So despite them smashing earnings, it's the economics that have caused the reversal. And ironically enough, it's been the second summer in a row where August has started with a dramatic reversal for stocks. If you cast your minds back to last year, there was a brief and sharp reversal that was centered on Japan. But this time around, it's the US in the crosshairs at the hands of the jobs report that I'm going to come on to in a moment. But this chart on the screen takes the US market, represented by the SPY exchange traded fund, and compares it to bonds represented by the TLT exchange traded funds. Essentially, it takes the US stocks over US bonds, where any upward movement in the line would represent equity outperformance, and downward represents bond outperformance. It's just another way of showing when it's a risk on or bullish market. And as we can see, this has been the case for the majority of the period on the screen here, until we've had this strong tick down where it's fallen below the 50-day moving average. And this year's August surprise came off the back of very disappointing jobs, which was compounded by some negative supply manager surveys. And then if you've seen the news, the US president was firing the head of the Bureau of Labor Statistics. But out of the three, it was the jobs data that was most significant. So firstly, this jobs data is really key as it's some of the first hard economic data that's causing market volatility at this scale. And when I say hard, I mean real economic activity that's already happened. It's also key because if you link it to the Fed has a dual mandate of price stability, which is a fancy way of saying it needs inflation to be targeted at 2%, but also full employment. So they directly look at the jobs data to either hike or cut rates. And I'm sure you've seen from headlines, Trump wants the Fed to cut rates immediately and by a large amount. And this data does support that. The non-farm payrolls data essentially means job creation on a monthly basis across the government and private sector. And the survey of economists thought there was going to be 105,000 jobs created in the month, and we only got 73. But the chart shows what's going on in the job market. So I appreciate you might have to squint here, but if you see that dashed black bar, it represents the figure reported by the Bureau. And if you scan from right to left, excluding the pandemic, you can see that 3-month job creation hasn't been this low since all the way back in 2011. But what's important is if you pick apart the headline figure, it tells an interesting story. So if you break that job creation down into its respective sectors, you have non-cyclical sectors like education and health, and these are very much constant no matter what's going on in the economy. They're critical jobs, so you should always typically see steady and stable jobs being created here. But take that away and look at the cyclical sectors, and job creation actually contracted. And as I say, that's not happened since 2011. And funnily enough, if you look at the manufacturing sector specifically, you can see that's one of the key sectors declining. Of course, it goes against Trump's master plan of tariffs and bringing manufacturing back to the US. So there's certainly a disconnect happening here. Now, I want to give a quick apology on how this chart looks. It was only recently ran as we were trying to pick apart this jobs data and understand what's going on after this recent print. So let me walk it through. There are 4 trend lines on this chart that measures the US jobs market. And the way we've charted it is that if the lines are moving down, the jobs market is getting weaker. And if it goes up, it's strengthening. And the blue line is the unemployment rate, and we've reversed it, we've flipped it so that if the line's moving downward, the unemployment rate is actually rising, and that matches the trajectory of the others. So the white line is job openings. So how many jobs can you apply for? The green one is wages. Again, if it's declining, then you're just not getting paid as much. And then the pink is another measure of employment costs, including your bonuses and all that stuff in. So the center of the chart really is the aftermath of COVID, where the US jobs market was very hot, very frothy. And then since that point, slowly and surely, the US jobs market has been cooling, as shown by that arrow we've popped on the chart there. But all apart from the unemployment rate. And if you read the FOMC minutes from last week and on the interest rate hold decision, the chair, Jerome Powell, was saying unemployment is historically low. The jobs market is fine and it's held up quite well. But what it doesn't take into account is the participation rate, meaning the labor force. So everyone working or looking for a job, which is divided by the working age population. And it's the effect of the labor force that's really important here. And that's actually declining. So there are less US workers in the pool, and we can speculate as to why that's the case recently with Trump launching the likes of ICE raids, but also there was a Bloomberg article that was stating new graduates were finding it very hard to find jobs right now. And one of the speculations is that AI has been taking a lot of the entry-level tasks at companies. Therefore, that's reducing the labor force. So this falling labor force or participation rate has counteracted any increase that the unemployment rate should have seen. So the fact that people are leaving the overall labour force and it's not showing up in the headline data is actually hiding the underlying weakness of the economy. And this explains why the unemployment rate isn't budging whatsoever currently, and why on face value, there's still record low unemployment in the US. So what does this all mean? To summarize, employment is one of the key metrics the Federal Reserve has to consider as part of its mandate. And this recent jobs report is really shaking things up for investors and markets. It reinforces the point we may see sustained volatility as investors, both to the upside and the downside. And I've talked to in the first slide, investors really can benefit from the likes of holding bonds in their investment portfolio at the moment. And that also links to point 3 on the screen here, where your diversification comes in many forms from regions, but also asset classes. And importantly, this jobs report was really like the unmasking of the US economy for many, and gives Jerome Powell the ability to entertain further interest rate cuts at the next FOMC meetings before year end. A lot can change until then. We're going to look to see what developments there are as we go through August. But for us, it really has bolstered the case to remain well diversified as we move into the back end of the year. We still look to access some of the great news stories from the likes of your mega cap names in the US. And there really are some good stories recently in the Mag 7 especially. But we also want to reinforce our stance on very much remaining risk aware and allocating to other catalysts through the likes of Europe and China. But that's all from me, Jordan. I'll hand back over to you for wrap up. Thank you.
Thank you, Josh. And thank you, everyone, very much for your time and for joining us today. As we've said, if you do have any questions over the content we've covered today, or perhaps want our insights into topics we didn't cover, be our guest, reach out to us using the details on screen for Josh and I now. Otherwise, that'll conclude today's webinar. We hope you can join us next time for the September edition, which is due to take place on Tuesday the 2nd at the same time of 8:50. All that's left for us to say is we hope you have a great day, and we look forward to speaking with you again very soon. Bye for now.